Hi there, I'm Andrew Macken and welcome to this week's Video Insight. Today I'm going to provide an update on the iron ore market, a market that is of enormous importance for our national income and one that tends to be near and dear to the hearts of many Australian investors. In thinking about the value of commodity producing companies, the single most important parameter to forecast is price. A producer's equity value is typically most sensitive to the price assumption. Unfortunately, price is also the most difficult assumption to get right. To frame how to assess if a commodity price is more likely to increase than decrease, you can ask yourself the following question. Is supply growth higher or lower than demand growth? If supply growth is growing at a faster rate than demand growth, then you can typically expect the price of the commodity to fall. If supply is growing more slowly than demand, then you can expect the price to rise. Over the last few weeks, the major iron ore producers each released their June quarter production numbers. Growth in iron ore production was extremely strong across the major producers. Rio Tinto and Vale grew their iron ore production at around 11 or 12% versus the same period last year. BHP grew its iron ore production by 19%. Meanwhile, Fortescue, as it continues to ramp up its production, grew its quarterly output by 82%. These are very strong supply-side growth rates. By contrast, demand growth, using steel production growth as a good proxy for iron ore demand growth, has been at around the 2 to 3% level. So supply growth is significantly above demand growth, and hence the iron ore price has fallen materially since the beginning of the year, by around 30%. This situation is unlikely to change anytime soon. To make matters worse, what tends to happen when the iron ore price is weak is that customers demand further discounts to the headline price index. This reflects a shift in the bargaining power from the supplier to the customer. We're hearing these discounts could be as high as 10% at the moment, which will hurt producer profitability by more than some investors currently expect. While the big producers will most definitely survive this period of weakness, the same cannot be said necessarily for many of the smaller producers that have much higher cost structures. Indeed, for many small high-cost producers, they are probably not even turning a profit in the current market conditions. Companies in such a position can sustain losses for a while, but certainly not forever. At some point, unless the iron ore price improves meaningfully, we should expect to see some bankruptcies in the space. That's all we have time for today. As usual, don't forget to follow us on Facebook and Twitter.